Hello, everyone, and welcome back. In my today's video, I'm going to discuss with you about a company called Utkarsh Small Finance Bank Limited. We'll go through the recent Q4 FY26 results and, go through the con call summary and get the main and important gist, right? And in case if you guys have been following this bank in the, microfinance space or not, because this bank was in turmoil, it went into losses, and now it's into the recovery phase. So let's get into that and let's understand their result and why I think that they're in the recovery phase and what are the numbers that they're showing that their things are improving, right? So let's just look into that. If we look from the Q4 revenue perspective, right, for compared to YOY, it decreased by around close to 5% to 837 crores, and PAT was down by almost they went into losses of almost 188 crores. And if you look for the whole year of FY26, revenue decreased by almost 11%. And how to say, the profit, the revenue was all around 3,379. PAT was down. I mean, what again, not PAT. I mean, they went into losses of almost 1,150 crores. So you might be thinking, Masood, when you are reporting this number to me at this point of time, right? Revenues are decreasing from profit. They've gone into losses compared to the last year. So how can you tell things are getting better, right? So see, this is where it becomes very important when analyzing companies which are into MFI space, which are coming out of the cycle, right? To see how the quarter on quarter is looking. Yes, if you look from the YOY perspective, things might look bad, but how things are getting better, right? Because if things are getting worse, then the losses would increase further. But if things are getting better, the losses would decrease. Because if you look at their quarter on quarter losses, right? So in June 2025, they reported a loss of around 239 crores. Then obviously it increased to 348 to 375. But if you look at March 2026, it decreased to almost half to 188 crores, which shows that whatever provisions or whatever they had to provide over there, that has reduced drastically. And if you look at the overall, provisions that they had to do, right, compared to the last quarter, right, last quarter, they did a provision of around 446 crores. But if you look at quarter four, right, the provision almost reduced half to around 244 crores. So that clearly shows that the bad loans are reducing and things are getting better and the provisions are also reducing. And if you look at the numbers, right, the numbers also provide the same thing, because we need to understand this, right? Because it's a small finance bank, majority of their exposure was related to joint lending groups. Okay, because that is more riskier compared to the other side of the business, which is the secured lending. So what the management has done, right? They have reduced their exposure to into this, on the microfinance side. Because if you look at their overall gross loan portfolio, right? If we compare to the YOY number, right? The overall it declined by 1%. But if you look from the distribution from joint lending group, which is the microfinance, and to the non-JLG up, so that's a quite difference. Because if you look at the GLG, it went down by 37.1%, and non-JLG is up by almost 30%. And if you look at the whole, quarter on quarter, the joint lending group, the MFI sector went again down by around 9.8%, and non-JLG went by 13.8%. So this clearly shows, right, the way management is moving forward or going forward with the bank, right? They're trying to reduce the overall exposure on the microfinance side and move their book towards the secured lending perspective. Because if you look at their disbursement also, right? If you look from the YOY perspective, right? For the Q, it grew by almost 30%. But if you look for the microfinance side, which is the joint lending group, it increased only by 2%. But the non-JLG group was up by almost 51%. If you look from the quarter on quarter perspective, it grew by almost 46.1%, where the GLG group was up by almost 58%, but non-GLG group was up by 40%. So you might think, so you are saying that they're reducing their exposure to the microfinance side, but here in quarter on quarter, the number grew. See, then in terms of percentage, the number high, but the overall exposure has reduced. We need to keep that in mind. And because the MFI sector is coming out of the woods, right? Obviously, the people who require the loans are more, and the bank is willing to give them depending upon the credit score. That's why it has increased quarter on quarter. And if you look at the loan book composition also, right, the secure lending part of the book, right, has increased from 43% to 51% this year. And if you look at the asset policy, the GNPA has reduced from 9.5 4% to 7.7%. NNPA has reduced from 4.8 sorry, 4.8 to 3.3%. And if you look at the cost of funds, right, which they incur, has reduced from 8.3 to 7.9%. So all these numbers, if you look at it overall, right, this clearly shows that the asset quality is improving. The secured part of the book is growing, and the management is concentrating over there. And if you look at their commentary also, right, what the management is saying, right, they clearly said that FY26, right? FY27, which it's going to be a consolidation year. The What will happen, right? The collection performance will even improve further. And when they will start giving these loans for FY27, right, they're going to be quite cautious, and they're going to give this loan to high quality segments also. And they will increase their deep and secured lending. And that is the reason management is very confident to give about their growth. They said that their overall asset under management will grow by around 25 to 30% this year. Secured part of the book will grow from 51 to 55%. Net interest margin will go above 8%, and return on equity will also increase by almost 15%. And another thing that they said, right, the credit cost which they have currently at three as so high, they're going to bring it down to 3 to 3.5% in FY27, and in FY28 they're going to bring it down further to 2.25%. So automatically, when the credit cost decreases, the profitability increases for the bank. So that is actually a good sign, but we have to wait and see whether they are able to do it. And on the NPA side, the management is saying, right, in the coming 2 years, they want to reach an net NPA number of 1% or less. So this shows that they are quite confident of improving their overall asset quality. So if you look at this business perspective, right, even though the last year was not that great for them, but what we can see, right, there things are getting better, and the banks have reduced their losses, and most probably it will come even further down, and hopefully they become profitable by FY27. If not, but at least by FY28 they should definitely become profitable. And if they're able to achieve that, right, this stock is definitely going to get re-rated in the market. So if you look at the play, right, so this is completely a turnaround play from losses to profit, but we have to wait and see how things progresses, right? Because there is one thing, things are getting better. Whether they are able to translate that into FY27 and FY28, we have to wait and see. I'm definitely keeping an eye on this company, and I'll definitely keep you guys posted. Thank you for watching this video. God bless you.